Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has over 40 years of experience working in the financial industry, including at hedge funds, director of research. He co-founded the hedge fund Bearing Asset Management in 2002. He also, for retail investors, has had the coffee can portfolio out there for people who can't afford to buy into his hedge fund. Kevin Duffy, thank you for joining me again.
Thanks, Jason. Thanks for having me back and making me feel old.
You look pretty good there in your picture, man. For someone who's
It's an old picture.
Oh, really? So we're recording this interview on Monday, January 15th, 2024. The dollar index is at 102.4. A lot of wackiness with what the Fed's done, Kevin, in the last 12 to 18 months with the pace of the Fed rate hikes. Now the bond market, in my opinion, is starting to get way ahead of itself. It's pricing in, 7 rate cuts? Do you think that is realistic for 2024?
Well, I'm not really sure, and I guess it depends on what the economy does. If the economy goes into a recession or a deep recession, then I suppose it's possible. But my big picture on the bond market is we went through this long bull market. Rates started in 1981 at 15% on the 10-year. 2020, 39 years later, they were down to 0.6% where they bottomed. Today we're at 4%. A few months ago, we were at 5%. We peaked at 5%. And, I feel like the long-term trend in rates is going to be up. The bond market tends to move in really long cycles. So I feel like the move up is going to be multiple decades, possibly, quite possibly. And, I think that one of the, again, kind of looking at the big picture in all this is that I think that the government bond market in particular is going to move from the lowest risk asset, or at least perceived that way, to becoming basically a junk credit. Okay. And so I was looking at the spread of the best grade corporate bonds over treasuries. And if you go back since the GFC, the average spread has been about 1.6%. Okay. And then you get into these crises, recessions, and the spread blows out. Okay. So that spread got up to 4.4% at the bottom of the GFC in March of 2009. And then again, when we got the COVID lockdowns, third week in March, we got to 3.1%. Well, today we're at minus 0.2%. So I think this is something that that investors aren't paying quite enough attention to, is that I think we're having a structural shift in terms of the bond market, and that the government. So we have. Obviously, the budget deficits and the debt, all these things are going to be problems, going forward. And the baby boomers retiring and really hitting the entitlements system, right now. So in 1981, so let's back up to this long bull market that we had, this long decline in interest rates. In 1981. The 10-year was at 15%, and the government had $1 trillion, just hit the $1 trillion debt level. Interest expense was 23% of tax receipts back then. Okay, here we are, we're at $34 trillion in debt, and we're approaching levels that are the same, even though rates are at 4%. So this is, I think, just fundamentally, structurally, the problem that the government has going forward.
The budget deficits are a mess. Both political parties in DC refuse to cut spending. I think I saw the estimates that we're adding $1 trillion to the national debt every 100 days now. It's just mind-blowing.
It is, and it's unsustainable. Again, kind of looking at this from 10,000 feet up. There's there's this talk about the everything bubble. And I think that if we look at that, I see it as really three bubbles wrapped up in one, at least in this country. One is the financial bubble, and at the epicenter of this financial bubble is the bond bubble that peaked in 2020. Okay, so we're now a good 3 years, going on 4 years into the unwinding of the financial bubble. You could also say that, so the bond part of it is one thing. Then we have all these peripheral bubbles around it. You had the meme stock bubble. You had the growth at any, profitless growth at any price bubble, Cathie Wood. All that peaked in February of 2021. So we got some data points here in terms of the top of the financial bubble. And then, you also have this imperial bubble. And I think that there's a pretty good data point on that, which would have gone back to 2003. And this was when George W. Bush was on an aircraft carrier 6 weeks into the invasion of Iraq. And there's a big banner behind him saying mission accomplished. And we're seeing just more. So this idea of the American empire, it's completely unsustainable, and all of that is now unwinding. And then you have this cultural bubble, and we saw that sort of manifested, I guess, in the stock market and with investors in terms of ESG. And really that looks like it's peaked as well. So it's a question mark in my mind when that cultural bubble either peaked, or maybe the peak is somewhere in the future. But I think you could look at all of these bubbles. They're all connected, and they've all either peaked or about to peak. And so what it tells me is we're going into a very different world, and that there is going to be radical change ahead. And I also think it's going to be a positive change. I think that this bubble, this everything bubble, rests on a false belief, and what ties all these things together is the belief in government as universal problem solver. So we've had this very long trend towards centralization, and I think it started really back in with the Constitution in 1789 and the Federalist vision of this country defeating the anti-federalists. And we've had basically over a 200-year trend in centralization. And I think what we're seeing right now, again, from kind of 10,000 feet up, is that this trend is exhausting itself, and it's coming to an end, and it's turning around. So that's my kind of big picture view of the world right now, or at least the United States part of the world. And the United States part is a big deal because the MSCI All World Index, the U.S. makes up about 70% of that. So I think that that's going to lead us to some opportunities as well, looking outside of the United States.
So I think to summarize what you brought up here is a lot of the policies, whether they're bailouts, rules changes, stimulus plans, stimmy checks, government subsidizing certain industries, picking and choosing winners and losers, like the ESG bubble, the return on investment, I would argue, was negative because there's a lot of bankruptcies, and then government keeps giving out subsidies. But I know here in the DC metro area, there's a lot of consulting companies and think tanks and PhD economists that keep cranking out research reports saying that solar, wind, biofuels will eventually, or very soon, either it already has or very soon, with a lot of adjustments in the papers, have similar returns to non-ESG energy plays. I think the free market, it wants deflation. The free market wants some type of deflation, this credit bubble, fiat currency problems, the credit problems to be solved. However, it's like the central planners, politicians, bureaucrats, PhD economists, people running the Federal Reserve Bank, they don't want deflation. Do you think that that's fair to say?
Yeah, I do think it's fair to say. I think it's basically a denial of reality. I think there's a belief that all they have to do is basically pass a law and promote this industry or that industry, and And they're what they're doing is they're promoting narratives, and those narratives are justifying big government. And that all works until it doesn't, until it hits a brick wall of reality. And this is what's going on right now. It's just that the people that are promoting all this stuff, they haven't gotten the memo. They're in denial. But at some point, the money runs out. You run out of, what's the quip by Margaret Thatcher? You run out of other people's money.
What was Margaret trading on inside information like Pelosi, though? Was she making an extra 5 or 10 million a year?
Yeah. Yeah. But all that stuff. But the thing is, reality will eventually exert itself. And I think that is exactly what's going on right now. When you see the interest on the national debt go up like it has, it's incredible how these people, they keep on pretending like this change hasn't taken place. But as I said, it has taken place, and it started back in 2020 with the bottoming of interest rates. It has, the banks are another problem. So the government, think about it. They decided back in 2020 under Donald Trump to stimulate their way. First of all, they're going to shut down the economy. Then they were going to try to stimulate their way out of it with $6 trillion in stimulus packages, of which seven parts of that went to special interests, and one part went to stimmy checks for people. They thought they could do that, and they, in order to pay for it all, they printed about that much money, about $6 trillion. And of course, that led to the price inflation that we're seeing. But also, about $5 trillion of that went into the banking system at super low rates. And what did the banks do? They do what bankers do. They put it to work. And now the whole banking system is essentially insolvent as a result of that, because they're sitting on all these interest rate losses that, of course, are not marked to market, because of the held to maturity accounting, et cetera, et cetera. But
Is that the Austrian theory of the business cycle? So the stimmy checks actually created an artificial boom, right? So the banks got this inflush of, so if our listeners out there, they got a stimmy check, right? The first thing they probably did was put it right into their bank account, right? It either went to their bank or they got the check and they deposit it. And in the banks, for our listeners out there with fractional reserve banking, the banks aren't just going to hold those reserves. They're going to put it to work. Like you said, they're either going to put it into treasuries, they're going to buy long dated bonds like Silicon Valley Bank, or they're going to expand their loan book. And now the banks have all these problems, right? So that's the Austrian theory of the business cycle.
Right. And, and so part of the problem is that they did both. They did, but a lot of this went into government securities and mortgage-backed securities. And this, I think right now, the banks are not able to expand credit. Okay, so the inflationary mechanism, part of it is broken down. The inflation, at least the monetary inflation that takes place, is kind of a two-step process where the government expands its balance. The Federal Reserve expands its balance sheet, and then that money flows into the banking system, and then they pyramid credit on top of that. But I think what's happening is less and less the banks are really not able to find borrowers. The economy is not strong enough. They're not able to really pyramid credit. So they're just basically putting that money back into buying government securities. And so this multiplier effect has been far less, really since the great financial crisis in 2008.
Well, from speaking to bankers off the record, it sounds like they're in the CFO surveys that are being released by the Fed and elsewhere. It sounds like at banks, it sounds like that they're reducing credit the last 12 months, but also like the banks, not just on treasury losses, like you said, they're sitting on losses on a lot of their high interest consumer debt, credit cards, auto loans. There's a lot of auto repossession. I was watching videos about that, about the repo lots. And then the other major problem, I think this is the biggest problem, there's not mark-to-market losses yet. It's a commercial real estate. I'm just hearing absolutely insane stories of everywhere in the United States, office building, multifamily for commercial real estate. The banks, the insurance companies, the pension funds, they're just sitting on mountains of losses.
Yeah, no, that's the next shoe to drop. Absolutely, I completely agree with you. And one of the things when Silicon Valley Bank blew up in March of last year, the Fed opened this bank term funding program, and so in the first few months it went from zero to $100 billion, and then it just kind of stayed there, sort of drifted slowly higher. Well, I just checked over the last 6 weeks, that's gone from 114 billion to 144 billion. So something is going on right now, and you would think that what's happened in the last 4 weeks. If anything, interest rates have gone down. This should buy the banks a little bit of breathing room, and yet it seems like, if anything, the problem banks are, things are getting worse, not better. So yeah, and then you're right. On top of that, the commercial real estate thing is a big deal, and part of the problem, people don't really understand, I think, quite the impact of higher interest rates on a loan book or on the value of government securities. So I'll give you an example. If a bank were to write a 30-year mortgage and at 3%, and rates were to go up just to 6%. Now we're a little bit higher than that. We're at about 6.7% right now. But at 6%, the value of that mortgage, the net present value of that mortgage, like if they were to sell it to another bank, they'd have to mark it down by 40%. Okay. So and
So
these
they're not going
loan
to sell it
books,
then.
yeah, they're not going to sell it because they would have to then report a loss on the books, and of course they're not going to do that. So this is the problem, is that all these banks are sitting on all these interest rate losses, and then on top of that, you mentioned the commercial real estate problem. This is a ticking time bomb. I totally agree with you, and yeah, I think the banks are in. I wouldn't go anywhere near a bank. Let's just put it that way right now in terms of investment. And this is, I think, what is kind of sitting below the surface right now. It's been papered over really well. They've gotten away with it so far, but the problems are still there. The losses haven't gone away. And if I'm right about the long-term trend in interest rates, look at it this way. Let's say that you asked about the scenario of, could we get 7 or 8 rate cuts? Well, the only thing, in my opinion, the only thing that brings that about would be a deep recession. If we get a deep recession, then those loan books, those commercial real estate loans, are going to be a disaster. You're going to have all kinds of write-offs. So the banks are going to get hit that way, but they're going to get a little bit of help on the interest rate front. If the long-term trend in interest rates is up, like I think it is, then they're just going to continue to bleed in terms of their loan books and their government securities.
What do you think the government's going to do then to try to solve? And I'm using air quotes here because, like, the free market, the banks would go bankrupt. The commercial real estate office buildings would be sold at pennies on the dollar. The banks would take the losses. That would be in a free market, allowing bankruptcy and deflation. But the government, they like to change the rules, do bailouts. Do you think that they're going to create a bad bank and just try to stuff all these office buildings in there, similar to what the savings and loan crisis are going to create an artificial bad bank? Or the Fed's going to say that, like, oh, hey, BlackRock or one of these other institutional investors, we're just going to give you basically free capital at 0% interest rates, like what they did for entire rows of homes for some residential real estate, well, from 2008 to 2012. And they're going to say, hey, BlackRock, why don't you be a commercial landlord for a bunch of these office buildings for, I don't know, 5 years, 7 years, but while the price of them starts to go up again?
Yeah, the first part of the playbook is to find a buyer, somebody, a JP Morgan, or I think First Citizens acquired Silicon Valley Bank. So, that's their the first play in the playbook. The problem is that every single bank got into this, not the same amount of trouble. Certainly, JP Morgan is in better shape than some of the regional banks, but they all made the same mistake, just a matter of degrees. So I'm not sure that there is a Warren Buffett out there or anybody with deep pockets that can really take this on. So, at the end of the day, it's probably plan B is going to be run the printing press. And I don't see where that's going to really, quote, air quotes, solve the problem.
Yeah, I prefer deflation. I'd prefer letting the free market work itself out with deflation and bankruptcy. I mean, you can't really have capitalism without bankruptcy, but they say it's capitalism. It's not really capitalism if the government's picking and choosing winners and losers for bailouts and bankruptcies.
Yeah, that's the stage that we're in, and it's going to play itself out. But I am a big believer in free markets, and I'm a believer that the government will run out of money. It will bump into reality, and we will move into a different phase of all this. But that doesn't mean that the interventionists won't go down without a fight. They will try to double down on the same policies that got them into so much trouble. But I think at the end of the day, the big losers here are the state. The politicians, the state. I mean, I think ultimately, long term, this is good news for everybody. But it's going to be very messy. This transition process will be messy and very challenging.
I would argue that there hasn't really been a net liquidity drain. So I know the Fed's official balance sheet is down over $1 trillion in the last, 14 months, give or take. But like you said, the BTFP, that program was created. It's well over $100 billion. The other program, and bankers and other people like John Titus of Best Evidence were looking into this. The other one is FHLB borrowing. So not sure if you looked at that, the Federal Home Loan Board. So banks normally, it's like super lean and it's a higher interest rate. The regional banks have been tapping that a lot more than usual. I think normally it's maybe a couple $100 billion a month, and it's paid. The loans are paid off quickly. It's like short-term liquidity with high collateral with a super lien. But at one point around Silicon Valley, and then a few months after, we got to well over $1 trillion borrowed from the regional banks. So that's a lot of net liquidity that's being pumped in. Also, the budget deficits, Kevin, I would argue the government budget deficits are also the size of them and the social program spending and all the spending that the government is doing for all the budget deficits and all the other transfer payment programs, Inflation Reduction Act, infrastructure, that's preventing deflation too.
Yeah. I think this, the problem with these, the bank term lending program and, all these lifelines to the banks is that this isn't free money. They're charging them real interest, 5% interest or so on. So, there's no way out of this. I agree. I think the Fed has been the liquidity hasn't been drained out of the system as much as advertised, but and I would imagine they can't allow it to really contract significantly, and yet the conditions are still they should get tighter, I would think. I'm not convinced that just because the Fed is talking about lowering interest rates, I'm not sure that let's put it this way. I think investors are looking at that as the green light. Like this is all of a sudden going to be the wind at our backs, and we can just buy anything, and another bull market is here. I just don't think it's that simple, and especially with the banking system in the position that it's at, I don't see where you're going to have just liquidity gushing all over the place. I think that's over, and we're looking at whether it be a tighter environment or just not as loose as investors expect. I think they're not going to get what they want.
Are you surprised at the performance of the Magnificent Seven, so the large seven or so big cap, large technology companies, and the S&P 500? I would call it the index fund bubble for passive investing. How well they did in 2023, despite all the problems that we're talking about with the Fed raising interest rates, the problems with a lot of the small cap companies, the banking sector, commercial real estate. Are you surprised then how well the index funds did and the Magnificent Seven?
Oh, absolutely. I'm very, very surprised. And look, obviously, if we go back to 2022, those stocks got hit pretty hard, and they were kind of the last to get hit. And once the leaders get trounced, it seems like you're at least at or near the end of a move on the downside. And so we got this huge bounce back, but I think it's also the idea that the same leadership has come back is a little bit suspect. I mean, you really want to see a bear market kind of finish its work and change the leadership, and we didn't really see that. So, we've gotten this funneling effect, just this massive funneling into 7 names and the top of the S&P 500. And I mentioned earlier, the U.S. is now 70% of the world equity market. I think that is, if you go back 50 years, it's like 2.5 standard deviations above the average. It's really, there's this, tremendous concentration. And I just look at it, as somebody who's looking for value in the market, that's just, I don't want to be there. I'm not finding a lot of value. I think if I look at the 7 stocks, there's some scare me more than others, but that's the bad news. The good news is that when you get bubbles like this, they also create anti-bubbles, and there's a lot of opportunity just sifting through the other areas that aren't getting anywhere near as much attention.
Would you consider like what happened with the Mag 7 then and the index funds? Is that like kind of risk off behavior similar to what happened with the capital inflows into like money market funds, short-term treasury? So they got lumped in there with like gold, Bitcoin, Mag 7. So there was all this capital globally, kind of like a mini dollar milkshake, what Brent Johnson has described.
So risk off?
Yeah, risk off kind of capital flight, mini dollar milkshake. So foreign capital, say foreign pension fund money in Europe or emerging markets, and they decided we're going to go into short-term US treasuries, money market funds, Magnificent Seven, Bitcoin, gold, kind of those things.
Yeah, I wouldn't call Mag 7 risk off though. I mean, I would call that more risk on.
I guess it depends which portfolio manager you talk to, because I mean, they're paying what they view those technology companies as safe, as in like they won't go bankrupt, but they're paying 50 times revenues for no growth.
Okay. So, right. No, okay. So, I think I understand more what you're saying. So it's a big difference between, if we were to go back to, early 2021, it was just, profitless growth at any price. Total risk on, nobody cared because interest rates were practically zero. I mean, who cares? We can look way out into the future. Okay. So the rally last year was very different than the rally in 2021, early 20, or I should say 2020 to early 2021. It was much more of a quality rally, much more of a cash flow rally, stocks with, like the Magnificent Seven, that maybe they didn't have the top line growth that the Cathie Wood ARK Invest fund had back in 2021, but they had cash flow. And I think those names did really well last year. It wasn't just the Magnificent Seven. I mean, there were a lot of stocks that would be, kind of high quality stocks that did well. So I guess in that respect, you could call it risk off. I just think it's a little bit different. It's just more of a quality rally, and if you pile into anything, I don't care whether it's low quality, high quality, at a certain price, it becomes risky behavior. And I think we got to that. I'm not saying every single one of the Magnificent Seven, but I think there are a couple of names in there. I would probably pick out Apple and Tesla. Those would be my 2 that I think are a little bit on the crazy side.
Well, I mean, in general, like the companies, none of them are going bankrupt, right, in the Mag 7, but the market's paying insane valuations for those. I mean, they're expecting, you watch some of these portfolio managers on TV and they expect multiple re-ratings where Apple's going to add another $1 trillion in market cap with no growth, and they still expect valuation multiple re-ratings going forward.
Yeah, and that's the thing, is that we're not looking at, it's a big difference between, I guess, going back to that early 2021 bubble where you could pick out some names. I wrote a piece back then, and I had a list of some of these stocks, and I mean, they have, like, Beyond Meat was one, and Peloton was another one, and there were some of these tech companies that they're down 90% plus. Um, Apple's not
All
going
the
down.
those were all the IPOs. Yeah, I mean, like Tilray. We were talking about this years ago. Like Tilray and those after the lockup period, Beyond Meat too. After the lockup period, like Tilray and Beyond Meat. I mean, those things collapsed.
They got taken to the woodshed. So yeah, we're talking about something different right now. I mean, Apple's not going down 90%, but if Apple goes down 40 or 50%, it's going to do a lot of damage. And of course, people are positioned in the S&P 500. They've looked at it like it's a piggy bank, and it's just on autopilot. We've had just massive, massive inflows into the S&P 500 index funds. A lot of money has come out of active investing. So, it just tells me that I don't really want to be spending my time if everybody is fishing in those ponds, and they're not even fishing. They're just on autopilot. I want to be looking where other people aren't looking. And that's basically, you could take the S&P 500, subtract out 7, so 493, and then look at everything else, and also look around the world. There's a lot going on around the world. China, for example.
Now, before we talk about like bottom up and some companies or sectors where you think there's contrarian value investing or potential growth that's discounted at reasonable valuations, I want to get your thoughts on inflation and then the woke index. So do you think that inflation, the government will actually allow inflation to head below 2%? Or do you think that the consumer price index doesn't reflect reality? So the consumer price index is going to say the Fed has the Fed has defeated inflation, and they're going to say the CPI is going to be at 1% soon. And then in the reality is going to be totally different. Do you expect that to happen?
So first of all, I think we have to, just make sure we get our definitions right on inflation. The old definition, the Austrian definition, would be monetary inflation. And I look at that as the printing press, and then on top of that, the bank's pyramid and credit on top of that. But I think what you're talking about and what most people are talking about is price inflation. So, there are other forces involved with price inflation. One of them is the economy. If the economy is strong, you're going to have more demand for credit. I just don't see that happening. So we can take that off the table. We can look at technology-driven deflation. There are clearly some, many positive things going on there. We could look at artificial intelligence. We could look at the decline of computing power, which is Moore's law, kind of run into some roadblocks, but still continues. These weight loss drugs. I heard that in the first year, that I think it's the Eli Lilly drug, patients lose something like 26% of their body weight, and obesity is a big deal. We spend on healthcare, we spend $4.3 trillion, and 14% of that, $600 billion a year, is obesity related. So, all those things can be positive. So I don't want to downplay that. I think it's important. But then you also have some of these things that you'd mentioned before, ESG, that drives up the cost of energy. You've got trade wars and onshoring. All this stuff is very expensive. It's very economically inefficient and wasteful, and it comes with a price tag. It's all going to be driving up prices of things. So yeah, you have countervailing forces, and then of course the wild card in all this is the Fed, and what happens if we get a recession and the banking system, the cracks in the banking system are exposed. Really, the only tool they have in their toolkit is to print money. So yeah, I think it's going to be a lot of these countervailing forces, but at the end of the day, um, inflation will probably win out. I'm not going to predict, when that takes place. We could have a period, maybe 12, 18 months of, I'm not going to say deflation, but at least with the CPI numbers, maybe not the 8 or 9% that we saw a couple of years ago.
Shadow Stats has an inflation rate around 9%. So, I mean, like what you described, though, those cross currents between inflation and deflation battling it out, it sounds like more distortions. The government and the central planners are going to create more problems. Misallocation of capital, as Austrian School likes to say, with the central planning and the government spending with the budget deficits. I don't see DC doing enormous spending cuts. So I think that's going to prevent a lot of deflation in the system for the most part. Especially if they spend more, if they do cut rates and the Fed starts doing more bailouts or whatever. I don't know what they're going to do with the commercial real estate. I don't think anyone knows at this point. I know they're talking about it behind the scenes. They're trying to figure out, they're aware there's a problem there. I don't know if they know how large. This looks like stagflation to me. I don't know if it's like 15% stagflation, but if it's 5% or 9% stagflation, I mean, it adds up over time though.
Yeah, I think again, I'm just kind of looking long term. I mean, making short term predictions is not necessarily my forte, but if I'm looking out 10 years, and that's really the idea why I came up with the coffee can portfolio and that concept that I borrowed, is just to look out 10 years, and if we do that, then all paths lead to monetary inflation, and at some point there's going to be a loss of confidence in the system, and that will come from many places, including from overseas investors. We've had King Dollar as being the world's reserve currency has been a luxury, and again, I think this kind of fits in with the imperial bubble. The fact that we've managed to alienate a lot of countries around the world, a lot of creditors, including the Chinese. So that is another factor that I forgot to mention that will be inflationaries. That we're not going to be able to just print those dollars and they're going to be sopped up by foreigners like they were in the past. So it's just another example.
I fully agree. Yeah.
Yeah,
I mean, look at the net treasury since the DC put those sanctions in place on Russia in early 2022 and confiscated around 300 billion of the Russian reserve assets. I mean, the net treasury purchases from the non-G7 countries, they're non-existent.
Yeah. It's the law of unintended consequences, and the people making these decisions, they're very knee-jerk, short-term decisions, and it always elicits a reaction, and this is what's going on right now. I think that you place sanctions, and then all of a sudden it leads to a chain of events that work against the political class in this country, and I just think that this is kind of the pattern that we're seeing all over the place. Whether it be sanctions on Russia, and what does that do? Well, it drives Russia and China closer together. It funnels cheap gas to China. It helps them. Then what do? We have this trade war with China, and what impact does that have? You can look at the CHIPS Act, and so the idea was that we would deny high-end semiconductor equipment to the Chinese. We want to try to limit their ability to develop artificial intelligence and a semiconductor industry, an advanced semiconductor industry. And then, you look at the reaction to that. And last August, SMIC, which is the biggest chip foundry in China, the experts predicted that they wouldn't, it would take a while for them to get to 10 to 14 nanometer technology. Well, they introduced a chip at 7 nanometers. And Huawei, which the Canadian government and the Trump administration basically cracked down on, they basically shut down their smartphone business for a couple of years. They came back and they're using this new chip, the 7 nanometer chip from SMIC, and they now just passed Apple in terms of market share in China. Okay, so all of these things, it's like it's the Nassim Taleb anti-fragile, right? You put pressure on China, and you're making China stronger, and and if anything, and again, we mentioned, it's like a house of cards. All these things are connected. Look at Apple. Apple's got this $3 trillion market cap. What if you're Apple? What do you do to justify this? You're going to need to come up with some kind of big innovation, big market, or whatever. And now you're basically having to deal with China, which has become far more competitive as a result of all these trade wars. So it's all just self-defeating.
There's also more tit for tat sanctions back and forth. I mean, I think Xi Jinping just said that Chinese government employees can't own iPhones too. So that's going to hurt Apple's market share in mainland China. Chinese employees can't buy iPhones. So if the Huawei phone is better, like you said, but then if they're banned from buying iPhones altogether, then they're not going to risk making the Chinese government officials mad.
Yeah, and it's all stupid. I mean, it's all self-defeating, and it all hurts the consumer. It all hurts the people, and the only entities that get stronger are the governments on both sides. And so, just because our government, shoots itself, or really the people, in the foot, that doesn't mean that the Chinese government won't react and do the same thing. It's a shame, and it's such a simple concept. Trade, if it's peaceful and voluntary, is mutually beneficial. There was a great article by Joseph Sobran, who has since passed away, but this was written, I don't know how many years ago, 10, 20 years ago, and it was called the Two Economies. And he compared what he called the tax economy and the trade economy. And he said, these are two entirely different economies. One, the tax economy is based on coercion, it basically is a win-lose situation. Okay, there's a winner and a loser based on coercion. The other one is peaceful and voluntary, and it's win-win. It's mutually beneficial. Which one? And of course, this is what happens when you start promoting trade wars. Is you get into this contention model, and you get into win-lose, picking, again, the government picking winners and creating losers in the process.
Well, the governments and large corporations and the banks and institutional investors are also doing this too with ESG policy. You created the woke index. For our listeners out there, what is the woke index?
I created I call it the coffee can woke index. And all I did was, as an investor, I think what you're trying to do is identify risks, and maybe risks that are underappreciated by other investors. And I just thought that wokeness is a risk. It's something that is a cultural risk for a corporation. When you have a company like Google, and you have all of these high achievers, to now try to undermine that with things like affirmative action and that sort of thing, those don't mix. I mean, those two cultures don't mix. So that's one thing from a corporate culture standpoint. It's dangerous and risky. I think also from a customer standpoint, we've seen the downside of the Bud Light ad campaigns and that sort of thing. Especially in an environment where we've gone into this very divisive environment. You risk, basically, if you're a mass market company, you risk alienating half of your market. So, I think that was the basic idea. I came up with this index. It's 5 companies. See if I can remember who they are: BlackRock, Nike, Google, couple more. I can't think of them, but
Is Disney in there? Because I mean,
Disney's
Disney,
in. Yeah, Disney's in there.
it's backfired big time for Disney. I mean, like
Yeah,
their movie sales, the box office ticket sales. I mean, the audience has just rejected a lot of their movies lately because they've been snowflake, virtue signaling,
right.
ESG. I mean, way too woke. People just don't want to be preached at to those levels, especially when you have like a family and small children. I mean, the stuff that they're exposing the small children to in some of these Pixar movies, and it's just too much.
Yeah, and this goes to the cultural bubble. This is why I thought this is part of the everything bubble, is the cultural bubble. And you just all I'm trying to do is kind of imagine this big picture, this mosaic, and that if you understand that these things are out there, and that bubbles, what they do is they first of all, they can do tremendous damage. So you have to be aware of that. But they also will do an about face and cause a tremendous amount of change. So just knowing where these all are out there and they exist, and they fit together is important. And I think it helps you as an investor at least know areas that you want to avoid, risks that you want to be aware of. And yes, I've heard people talk about Disney and it's a great company, et cetera, et cetera. And these are problems that are self-inflicted and they're fixable and all the rest of it. But um,
Well,
my concern is that they run deep, that ideology is not something that is easily fixed. Ideology has very high switching costs, I like to say. People don't just change their ideology. And so, once you're infected with this stuff, I don't see it as a simple fix. So it just, for me as an investor, I want to try to avoid companies like that.
yeah, I
I'm
agree.
not saying you
I
can't
think
make
Disney.
money, and I'm not saying that they can't be fixed, but I would just rather focus my attention elsewhere.
Well, I think Disney has some serious problems. They have high capex for like their cruise ships, their theme parks, funding all those movies, television with the streaming stuff, Disney Plus, and some of their other streaming stuff. So they have high capex bills. But I think they put themselves in a very difficult spot long term, where basically they're in almost a no-win position, so they can piss off all their friends in Hollywood. So all the people that are involved in movies and television and stuff like that, so like the actors and all the movie executives and on all the people that work on film crews, they can piss those people off, or they can piss off their customers. So their customers are saying, hey, look, we don't want to be preached at. We don't want woke culture. If they have small children, they don't want their children exposed to certain things. The customer is saying, we don't want to purchase your movies and your television shows that are going to be preaching this stuff to us. But then, like, if they switch, like you said, they're going to piss off all their friends in Hollywood. So they're kind of basically in a no-win situation at this point.
Yeah, and with these bubbles, when you're in the midst of a bubble, you're completely oblivious to the change that's going to take place, and you just extrapolate this for forever and ever. And they're vicious. When these things turn, they're vicious. And so I look at this cultural bubble, this wokeness bubble, whatever you want to call it, and it seems to me like at some point we may be in the denial phase right now, but at some point there will be a backlash. It's almost like I'm thinking back of the 1970s. There were the disco, right? And disco was kind of like a bubble, I guess. And and then there was this famous scene at Shea Stadium, I think, where all of a sudden disco was out and there was this backlash, and they had this bonfire, and they were just burning all these disco records. And it's to me it seems like we could have the same thing with a lot of this this woke content that's being created today. One of the reasons why you do that as a content creator is you want to have a long life with your content library. Well, a lot of this stuff could end up being like going the way of those disco records and end up in a bonfire.
Well, the original Snow White movie was a classic, right? And that's been running since what, the 1930s or some post World War II, I believe. But like I think they were trying to remake the Snow White into a live action stuff, and people saw the movie poster, and Disney had to. I think they said they're going to reshoot or scrap it. But I mean, people just don't want to see like transgender and gender fluid dwarves, and like it's for little children. I mean, it's just way too much.
I agree, but to each his own.
Well, it's backfired. I mean, look at their box office sales, like their Marvel movie, Star Wars. I think like
Yeah.
I think it's way over $10,000 for a family vacation to Disney World or Disneyland now for a family. For I used to live in Southern California. An annual pass. This was 25 years ago. It was $125 for an annual pass to Disneyland when I was a teenager, when I was in sixth grade or middle school. I think like for a 1 day pass for an adult now at their theme park, I think it's it's $150 or something like that. I don't even think you can get a little kid's ticket for $120 now. So the price hikes are enormous.
Well, but this is the good thing about the great thing about the free market is that there are feedback loops and that there are, the customer is king. Profit and loss at the end of the day, these companies have to be profitable, and they will be forced. They will be forced to make changes. There's no two ways about it, and there's a difference between that and I just think the institution of the state. It still is subject to the laws of economics, but those feedback loops are much longer. They take a longer time to go into effect, but they are coming.
So I want to ask you about the coffee can portfolio, the model portfolio. Are you focused on dividend growth? What are you looking for the retail investors for the coffee can portfolio, the model portfolio in your newsletter?
Well, I try to do a number of things. The first is, and I look at, first of all, I like to look at investing as a game. It's this, very complex. The economy is very complex, and I think of it as the million piece jigsaw puzzle that's constantly changing. And so we need to try to find edges in the game. And so one of the edges is simply to look long term. That's where the idea of the coffee can portfolio came. Trying to look out 10 years. The second is trying to cast a wide net. So I want to try to be able to make money not just as a value investor, not just as a gold bug or a gold stock investor, but also as a growth investor. I want to be able to look all over the world, really cast a wide net. So I'm not just limited to dividend paying stocks. I'm just looking for opportunity wherever I see that opportunity.
But you're looking for good. So it might change with sector or industry, but you're using fundamental analysis, right? For good businesses at reasonable or cheap valuations that have some growth that's not being priced into their valuation.
Right. So again, I think we can look at this puzzle, right? This million piece puzzle, and we're trying to get some of these big pieces, trying to get some shapes here and see what this looks like, and then that will lead us to different themes. Okay, so I would say that what is kind of constant about the way I manage this portfolio is one of them is to look for these different themes that we can invest accordingly. So we talked about price inflation. We talked about ESG, and the cost of energy being driven up, and the effect that this is having on the middle class. So one of the themes that I have, just as an example, is the middle class being squeezed in developed countries. That to me seems like a pretty obvious trend, and it's one that's been going on for a while, and it will continue to go on for a while until it doesn't, until hopefully a lot of this nonsense goes away, and then we can be done with that theme. But at least for the foreseeable future, that's got some legs. So then it becomes, once I've identified a theme, you're just doing your bottom up work. You're just looking for Are these good businesses? What are their competitive advantages? As it turns out, a lot of you've got the discounters that have economies of scale. They're good businesses. They're defensive. So that leads you to the stocks. You have a subset of the stocks that you're looking at, and so for example, just sort of drilling down into that theme, so I'll look at the discounters. You've got Walmart, Target, Costco. Those are the big ones. You've also got the dollar stores. Let's take the dollar stores out of the equation for now, and then BJ's wholesale. So maybe four companies. We might be able to think of some others, but those are, in my mind, would be the big ones to look at. Okay, so Target, we've got some wokeness issues there. Target got really cheap. I'm sure you could have traded it. I was really tempted to, because the company has been well run and has done well, but I just felt like there was a risk there, so I couldn't pull the trigger on Target. Costco, too expensive. Walmart, doing everything right. Big insider ownership. Great stuff, but the stock's a little bit too expensive. And, so that led me to BJ's wholesale, which trades at like 16 and a half times earnings versus 40 times for Costco. And the growth looks like it's a much smaller company. It's like 1/12 the size of Costco. It doesn't have the international growth profile that Costco has, but you look at something like that at 16 and a half times versus 14 times, and it's got the wind to its back. So that's kind of the process, Jason, with how I go about it.
Yeah, it's their business model is almost exactly like Costco. I mean, there's a lot of American listeners out there. It's very similar to going to a BJ's wholesale club, similar to Costco, except like the customer service might not be as good, the food court's not as good, but they sell very similar products. It's a warehouse club type of environment, very, very similar though.
Yeah, and they don't sell as much in bulk. It's a little bit more if you're not buying as much, it's a little bit more convenient for that buyer. And you look at the demographics in this country. People are staying single longer. Families are smaller. So I think they kind of benefit from that as well.
Now, you mentioned ESG. I would argue, and I've been looking at this for the last like 6 months. I mean, the valuations, I've interviewed oil hedge fund managers, the valuations on these non-ESG energy companies, so coal producers, and there's not many left because there's been forced mergers and acquisitions. A lot of oil producers in the US and Canada, the cash flow multiples on these companies are very, very low. And then because of these, I would say, stupid ESG policies, I mean, there's new press releases out the banks. They don't want to fund a new oil project. They don't want to fund a coal mine. And maybe they're going to fund some nuclear power plants in the next decade or two. Maybe I'm cautiously optimistic that they actually will, some of the people in power, but it just seems like institutional investors, banks, they don't want to fund non-ESG energy. So there's very, very cheap valuations there for cash flow.
Yeah, absolutely. And, that's why I like to get these pieces in place and then look at, what is being neglected. And I think this is clearly an area. So we do have, I'm not going to mention any names, but we do have investments in, we've looked at the E&P companies, oil and gas E&P companies, some of the oil field service companies. Offshore drilling is kind of an interesting area. Basically, almost the entire industry went bankrupt, and they've come out of bankruptcy with clean balance sheets, and that's worth a look. So yeah, there's a lot, definitely a lot to look at. Energy didn't really had a great run up into the Russian invasion of Ukraine. Kind of peaked at that point.
It was about 12 months, right? It had a big, it outperformed everything for about 12 months, I think.
Oh, yeah. It went on a rip. And, but, This is the thing is that there's always something interesting going on. You get this big rotation in the market. Last year, the year before it was energy, and then last year was a Magnificent Seven, and energy didn't do anything. And so there's always something interesting to look at. And yeah, I would absolutely today. I'm more and more interested in the energy and more broadly the commodity space. Definitely.
Yeah, I'm a contrarian value investor, but I'm also looking for undervalued growth too. So I would describe a lot of my philosophy as more of a Sir John Templeton. He's kind of a mix of value and growth, and he looked for like really hated sectors where the valuations were good, the growth was not priced in. Uranium a couple years ago was exactly like that. So like Cameco between $8 to $12 a share, people absolutely hated it. Now that Cameco is almost around $50 a share, it's not as cheap. So maybe if there's a pullback, but at these valuations, no, I'm looking for the next sector or industry that's similar to uranium from a couple of years ago. So we were talking before I started recording, I think 3D printing over the next 6, 12, 18 months, that looks like it's a lot starting to get leaner and meaner, because like a lot of these Silicon Valley industries, there was almost unlimited capital when interest rates were near zero. What they were getting way too much capital. Now that they're starved of capital, these companies, the senior executives are going to have to force to become efficient, focus on profit margins, free cash flow, and the valuations are going to stay cheap for a while.
Yeah, I'm a huge fan, or was a huge fan of John Templeton, and he's the ultimate contrarian and would look anywhere in the world. He's always looking for the point of maximum pessimism. Um, I'm thinking back, some of the better picks that I've had over the years have been, just things that got so absolutely destroyed that nobody would touch them. Natural gas E&P was that was the first issue of my newsletter. Natural gas prices, I forget where they were, but they were at the rock bottom, and things just couldn't get any worse. Um, and those have all been kind of multi-baggers. But another area that I can think about in terms of like getting really bombed out. I mentioned the offshore drillers. That's a good example. Remember in China the tutoring companies. Remember how Xi Jinping was going to put them all out of business? Those stocks, you look at some charts of those stocks, they got absolutely destroyed. And I recommended New Oriental, which is the biggest, and at $20 a share. And of course, this is what happens when you try to catch the falling knife. It ends up going to 10, right? I recommend it, and when I bought it, my thinking was, okay, well, they have no debt, they have enough cash, they have more than $20 in cash. And I figure the Chinese absolutely, very much love education. The idea that you're going to put this company out of business it doesn't seem like it's going to happen. And I've got a margin of safety. And the business didn't go away right away anyway. So it's been really interesting to follow this industry and to follow the stock. And what happened was they adapted. They found other markets. They were not put out of business, and that they're now their business actually has almost recovered from where it was. The stock hasn't recovered, but the stock is at 77, I think, up from 20. So these are the kinds of things that take place, and it kind of leads me to my next idea, which is China. You talk about all the negative headlines on China, and it reminds me, Jason, of all of the negative the narratives on China remind me of the late 1980s, when all you heard about was America's decline and Japan's rise. Japan all the experts were predicting that that we'd all be pushing brooms for the Japanese by the end of the century, that they would be number one in technology, and they were just targeting each of these industries, and they were going to put their industrial policy model was superior to the free market model of the West, in particular the United States. That was the narrative. And to me, if you just switch, and of course, Japan made up, I think at the peak, its market cap, its equity market cap is something like 50% of the world market cap. Okay.
And Tokyo real estate was insane too. Yeah.
Right. Real estate was a part of that. There were, that was a huge part of it. So, and of course, you can see that. I mean, if you had talk about making a contrarian bet, and I actually did back then, because I bet on companies like Dell Computer that went public in 1989 around this time, and we bought Dell Computer for book value, right?
And then it went into a bubble 20 years later, right? It was part of the tech bubble.
Yeah, so it would have been, I'm trying to think here, I think February of 1990, stock was trading at book value. And so 10 years later, we had the tech bubble. And I don't know of course, I didn't hold it the whole time. I wish I had, but, that stock went up. It was easily 100 bagger over that time. But that's how cheap the stock. There were a lot of stocks, great U.S. technology stocks that got dirt cheap in that time frame. But it was everybody wanted to own Japan.
But I just wanted to ask you though. So you said book value. So the market didn't understand that the growth estimates were reasonable. Then the market thought there was, the Dell's going to get put out of bankrupt by a Japanese tech company, and they're not going to have any growth. Then that was the narrative.
Well, yeah. So there was, there was a company specific problem. There were a couple things. First of all, Michael Dell was very young, very inexperienced. Nobody gave him any credit at all. Second, when they went public, he basically made a mistake. There was a kind of a boom in memory and DRAM, and he ordered too much. He overpaid, and then when the bust came, he was sitting on all this overpriced inventory that he had to work off. Okay, so even though the top line was growing at 25-30% a year very nicely and consistently, the bottom line got torched right in the beginning. So, you put those together, and then you have this really lousy market for technology stocks. So it was the perfect storm for Dell, and that's why it traded. Not only was it trading at book value, but a third of the stock price was in cash, no debt.
Wow.
Yeah.
Those are rare to find now. Almost never find stuff like that anymore.
No, you don't. Those were, we can only wish for that to happen. But, it reminds me a little bit. And, all these things are different. They're not all the same. History doesn't repeat, it rhymes. But it does remind me a little bit of the narrative today where, I think, China is like, the narrative surrounding China is almost like what it was with the U.S. And I just think that this is just my sense from what I've seen so far. My sense is that people are really underestimating China, and I think if we look out 10 years from now, they're going to be very competitive. I think they're going to get a lot more credit for being far more innovative than the perception is today. And, look at some of these stocks. Look at Alibaba. Alibaba is trading for 7.3 times next year's earnings. 45% of the stock price is in cash. They just announced, a few months ago, they announced, or last year sometime, I think a $10 billion stock buyback. Obviously, they have plenty of cash to execute that. And the thing is, I don't even have to be all that right. If the perception is just, slightly wrong, that you're going to do okay. But if my experience, when you get these big narratives where everybody is on one side, that usually it isn't just that the narrative is a little bit off, but usually the narrative is off by 180 degrees. And so if this thing is off, if all the pessimism surrounding China is off by 180 degrees, then I think you have to be paying attention to China. I think you have to be rummaging through and looking for opportunities.
Well, I also think another way to play China, and Jim Rogers has written about this too, is that China is going to continue to consume more calories. So for food, China is going to continue to consume more energy. I mean, the narrative out there, I'm seeing all these articles, is that we've achieved peak oil demand. There's going to be tons of electric vehicles increasing for decades going forward, or I don't know, maybe it's just going to be nuclear powered instead of electric vehicles, but that like all the so natural gas, coal, oil, diesel, gasoline, those things have the demand for those has peaked. I don't really see that. I don't really know how we're going to get rid of diesel, considering most of the supply chain runs on diesel and can't run on electric vehicles. I mean, have you ever seen a pickup truck that's actually hauling an electric vehicle pickup truck that's actually hauling heavy material? I don't think I've ever seen one yet. All the electric vehicle pickup trucks I see here around here, driven by like the Obama, oh, not Obama. Well, some of them were Obama, the Biden green energy people and stuff like that. They're all empty. There's nothing in the pickup truck bed. So those $100,000 electric vehicle pickup trucks, they have empty pickup truck beds.
Yeah, I think you make a good point. There are multiple ways of looking at the China situation. I think that's a good second one to look at, a good driver for these energy stocks. And I think there's a third way that we're playing it, which is also companies, American retailers that do business in China, and we have a couple. I'll mention, actually, I'll mention one, not a retailer, but I'll mention a restaurant chain, fast food restaurant chain, which is Shake Shack. So Shake Shack opened its first restaurant in Shanghai in 2019. They are expecting to have by 2030 55 Shake Shacks in China. Okay, and one of the things that I like about this is that I feel like as an investor, you're always looking for what the government is doing to kind of screw things up, and I'm looking for entrepreneurs to solve problems that the bureaucrats create, right? And so
Yeah.
if they're creating contention and they're pushing this constantly, contention, conflict, China is our enemy. Well, trade is mutually beneficial. If that's the case, then you want to trade as much with China as much as you possibly can. Okay, and cutting that off from an economic standpoint makes absolutely no sense. So, who are the best ambassadors to China? It's Shake Shack. It's taking American culture and sharing it with the Chinese. That's the best. So, to me, you're not only, I think of it as it's my way of being ESG, my way of being kind of socially responsible.
Well,
Right?
it's
Is
also
it,
higher
is
quality.
it
You have to look at the restaurant industry too. I mean, a Shake Shack hamburger and their quality ingredients are you're paying more money, but it's way higher quality than McDonald's, at least here in the United States. I hear McDonald's has higher quality in other areas, but like Shake Shack has a good chance to take market share away from a lot of those fast food companies that are using like, let's say, Frankenfood or GMO ingredients that are not as healthy or don't taste as good.
Yeah, and Shake Shack is in the Middle East. I mean, they're all over the world, and it's still. I think the growth story has a long, long way to go. So yeah, I mean, that's the thing. There's just so many different ways of playing China. And look, if you don't like the VIE structure and you feel uncomfortable with that, there are different ways you can buy American companies like Shake Shack that are doing business in China. Lululemon is another one that has been phenomenally successful in China. Lululemon is a very expensive stock. I wouldn't buy it, but and it's actually Lululemon is not an American company. It's a
Yeah, I
Canadian
think they're out of
company. But
Vancouver. Yeah, I think they're out of
yeah,
Vancouver, but I
but
think like they have a lot
yeah.
of American ideals. I think the former founder, he used to put like Ayn Rand quotes on the bags, and then like yeah, they kicked him out because like Lululemon's like I don't know, cozying up to woke culture.
Oh yeah, sure. Well, you get a lot of that when you get into the apparel business. Unfortunately, it's kind
Larger
of
corporations dealing with banks. So the larger you get
yeah.
as a corporation, the more you deal with the banks, the more you deal with larger governments, the more it is like ESG and woke culture, especially, I mean, like the bank's policies. I mean, anyone who says like anti-woke stuff, if you're a small business owner or stuff, they're threatening to shut your bank account down now. It's all, there's kind of de facto social credit score now in a lot of instances here in the West.
Yeah, there's we're cancel culture. We've got it on the left now. We've got it on the right. If you say anything negative about Israel and in the Israel-Palestine conflict, you're getting canceled. So it's just another sign of how there really isn't much difference between the left and the right. They're just two sides of the same interventionist coin, in my opinion.
Well, I think the Davos crowd and the World Economic Forum, I think they love it. All this infighting where people are fighting like of race, class, gender, ageism, because like the baby boomers have drawn out so much in the social spending from the government with Social Security and all these other transfer payments. So while these people are infighting, I mean, they're just starting to impose all these nefarious systems that are anti-freedom, anti-free market, potentially central bank digital currencies, cashless society, social credit score, similar to in China, mainland China, the social credit score, Chinese Communist Party. I call it the China model. So it looks like a lot of the Western politicians, the Davos crowd, that's what they want. So while we're fighting with each other over, small issues, woke culture, fighting over each other with this, the elites are putting in very nefarious draconian policies.
Yeah, it's that's the playbook. The playbook is all about contention. It's all about conflict, and this is what drives the state. I think that what's happened is they're running out of basically conflicts, fights that they can pick. So we've got the left fighting with the right. We've got, as you mentioned, young fighting with the old. We have man now against the planet, and we have the East against the West, U.S. against China. I mean,
Gender wars
what's
too, yeah.
left?
Gender war. I mean,
What is left? And so maybe what's happened is they've exhausted themselves, and of course now these things are all they're kind of starting to contradict each other, and I think this thing is all going to kind of come down due to its own inner contradictions.
well, I think a lot of people that are argued so much in this infighting on social media and on the mainstream media, they're not using rational thinking. I think a lot of them are either paid to promote a certain narrative or agenda, maybe their bias or their political career, the way they earn their salary is based on promoting a certain narrative or agenda. Because while everyone's fighting over what race, class, age, gender, all these different things, there's a bunch of even crazier stuff happening behind the scenes, like bigger picture stuff that's more terrifying.
Yeah, but as an investor, look, it is what it is. But as an investor, you can either complain about it or you can actually kind of celebrate it because it does create um, irrationality, and that irrationality creates opportunity for the rational investor. So, I'm not going to really sit here and complain too much about it. Obviously, we want to try to do something about it, but
Oh, I agree.
in the
I,
meantime, let's make a little money.
I agree. The other major point here is you can't save, for our listeners out there, you can't save over 10, 20 years in debt-based fiat currencies because of what's going on, all the policies, the governments. I mean, there could be bailouts, there could be, look, from Kevin brought this up, what, 6 trillion from in 2 years, from 2020 to 2022. The DC decided and the Federal Reserve Bank decided they just wanted to create 6 trillion of fiat currency units. The regular American only got stimmy checks. The rest of the stuff was what, bailouts and government spending that we
Right.
don't have audits over where the actual currency was spent.
Yeah.
So you got to invest. You can't hold fiat
Yes.
currency long term. That's the main issue here. You're like, well, yeah, you have to invest if you want to maintain your standard of living. You can't hold fiat currencies long term.
Yeah. No, I think that's an excellent point, Jason, is that you don't have the luxury of just basically crawling under a rock and or putting your money under a mattress. You are forced to recognize that and my working thesis is that the currency that we'll have a hyperinflation over the next 10 years at some point. Don't ask me when, but I think that there's a pretty reasonable chance that will happen over the next 10 years. And if it doesn't,
the dollar or all the currencies?
Yeah, I'm not. Yeah, all of them.
I mean, Argentina is clearly first, and Malay inherited a disaster, right? So I mean, he has to try to stabilize. What our listeners? I have a lot of libertarian friends, and they're criticizing Malay for trying to switch to the dollar, but he inherited such a mess. I mean, if the real inflation rate is 50 or 100% per month, he has to try to stabilize the currency first.
Yeah, no, I agree. I agree. But there's. So I think that as an investor, I like the term via negativa, which is the study of what not to do. And I think investing, a lot of it is about subtracting, a lot of subtraction, a lot of it is about figuring out what not to do, where to avoid. We talked about the woke cultures. Okay, you take that off the table. Government bonds. I don't want to touch government bonds. That's so we can take big chunks off the table. We can take fiat currencies. We can't put our money in fiat currencies, and so you realize that, all right, I need to be over here. I need to be investing with, I think of the stock market as a market for entrepreneurial talent. That's really what we're looking for, trying to find the best talent at the most reasonable price. And that's the game that we need to be playing right now in order to protect our savings and our purchasing power. We don't have a choice. The choice is to let it be destroyed.
Yeah, I 100% agree. I mean, for short periods of time, you can go liquid. You can have money market funds or short-term. If the government's going to give you 4.5% for 30 days, okay. But if you hold if you're loaning the government for 20-year bonds, 30-year bonds, or you hold fiat currencies 10, 15, 20 years, you hold a lot of dollars for that long period. I mean, I know people that I've spoken to older people that stayed out of the stock market since 2008, and they didn't know when to get back in. I mean, their purchasing power and those dollars, a lot of it's been devalued enormously.
Yeah, and there's another part of this too, is that if you have an interest bearing, if you've got cash and you're getting paid interest, you're going to pay taxes on that. And so, one of the beauties of investing in a stock, if you can find something that you're going to hold for 10 years, is that this is compounding without being taxed along the way. And there's a huge difference between holding something for 10 years, let's say, and paying the tax at the end of the 10 years, than paying tax every year along the way as it's going up in price. You're going to compound at a much higher rate. So I think this is another reason why it's important to start looking at equities and trying not just equities that you're going to be trading in and out of, but trying to find some coffee can type stocks that you can hold for 5 or 10 years.
That's an excellent point. And the government doesn't like people buying and holding for that long a period of time. I mean, real estate investors, there were some real estate investors with the 1031 tax exchange. They hadn't paid capital gains tax from selling properties with 1031 tax exchange for decades. Well, what happened in the last 2 years? The government changed the rules. And I think now every time a property sold, there's no 1031 tax exchange. You have to pay taxes.
Yeah. Well, look at somebody like Jeff Bezos. I mean, he's no dummy. He figured out how to compound. Basically, compound this tax-free. Build this business without without it being taxed along the way. So he did a masterful job. He kept the profits low by reinvesting in the business, and he built a hell of a business. But he understood the magic of compounding and basically not paying the government along the way, among other things. He did. I mean, I'm not saying that's the only thing he did, but
he also had the divorce tax too.
Yeah, that's true.
Okay, yeah. That's all jokes aside. This is not a red pill dating podcast, so I want to thank you so much for your time. For a retail investor, so Kevin's a hedge fund manager. SEC accredited investors for your hedge fund. For retail investors who are not SEC accredited investors, there's the coffee can portfolio, right?
Right. And there's a website, you can Google it, or it's thecoffeecanportfolio.com.
And we'll put links to all that stuff below the interview in the information and description section. Kevin's also on Twitter. I think he puts out occasionally some macro charts and some articles. I think you just put out a geopolitical article recently too.
Right. I did a long piece on the Israel-Palestine conflict, and that's actually available. You might link that in. It's I've got a landing page at the website, and it's thecoffeecanportfolio.com/Palestine. It's a history of the conflict going back to World War I, starting with the contradictory promises by the British to the Zionists and to the Arabs when they were fighting the Turks in World War I. So it's a very long piece. Took me a long time to do the research. And I haven't gotten a single negative comment, which is pretty amazing considering the position I took.